main thing, if you're brand new to real estate or anything like that, and you see those $100 conferences for 3 days, you're getting sold something. That's what it is. So just keep that in mind. Everything they're doing at that event, 100% of what they are doing at that event is on purpose to convert you into some sort of sales funnel by design.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 33 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and we got a really special episode coming at you again. We have Mr. Tarl Yarber filling in for Mauricio. Mauricio's at some conference right now or something. But for those of you who don't know, Tarl is a event organizer, a capital raiser. He's flipped over 650 homes. So we're really lucky to have him join us. How's it going, Tarl?
What's up? I wasn't just filling in. I thought this was my interview to see if I can permanently fill in for Mauricio, right?
That's for AJ though. You weren't supposed to say that. How's it going, man?
Going great. Thanks for having me, guys. Jay and I used to do these every week together, and then he met you, and then he stopped doing them with me, and now he's on this podcast with you guys. And then, but I'm just happy to be invited. That's all that matters.
Yeah, when COVID hit, Tarl and I, literally, Tarl called me up one day and said, okay, we're sitting at home anyway. We might as well jump on Zoom and do, I don't remember what it was. It was a panel, actually.
Yeah, we would do panels.
And the first one was you, me, Ken McElroy, and somebody else.
Kathy Vecchi.
Kathy Vecchi. And so we just jumped on a Zoom and knocked out just basically this.
Yeah, it was a live webinar. We had 1,200 people live on it for the first one. And we were averaging about 12 to 1,500 people during, we had AJ on it before too, right? And then basically saying, what the hell's going on with real estate right now? What's happening? It was just our way to kind of help navigate that, talk to people.
You know, if you would have had the idea that we drink during that thing, this would be your show.
It'd still be happening.
Wow, drinking live though, that might be in trouble. You never know when AJ is going to get racist.
Tarl, I go nuts.
My caffeine. Tarl, what are you drinking tonight?
This is a Moscow Mule.
Moscow
from Salt Lake.
Nice. Little vodka. Nice. All right, Jay, how you doing tonight?
I'm cold. It's freezing again. It got back up into the 80s last week, and now we're back down in the, I think, low 60s. So I'm like, look at this. I'm wearing long sleeves. I'm wearing a sweatshirt. It's just nuts.
He just loves rubbing it in at AJ.
Yeah, he does. Absolutely loves it.
38 degrees here.
Well, let me tell you how cold it is. I am actually tonight, before you ask, I'm drinking hot coffee with some Irish cream liqueur, and in honor of Mauricio, who's not here, it is Kirkland brand, so got it at Costco.
Nice. AJ, what's going on, man?
How's it going? Doing good. I'm and it's, really hot here. So Jay, we got up to 51 degrees, which is basically a heat wave here. So that's been nice, but be jealous of us. But going good.
Yeah, I was giving AJ shit before about he doesn't show up till 7:01, and then all of a sudden he logged on at 6:45, and I was like, AJ's early, but it was one of his assistants, of course, setting everything up, and then AJ didn't actually show up on screen until 7:01. So I thought you'd turn the corner, AJ, but nothing's changed.
Listen, consistency is the most important thing in life. So,
But it is interesting. It's a good reminder. We start recording this thing Tuesday nights at 7:00 Eastern. We release it Wednesday morning at 7 a.m. Eastern. So 12 hours from AJ hopping on till the time you guys can be listening to it. That's pretty impressive.
It is. It's a big turnaround.
That's very impressive, actually.
Yeah.
Well, let's try and keep this to 0 edits so we can keep up our track record.
Kyle, what are you drinking?
I went with kind of an old faithful that everyone knows. I went with the Maker's Mark. You'll see it at every bar. Everyone who's had bourbon has had a little bit of it. So I thought I'd pull it off the shelf, give it another crack.
One day I'll tell you a good story about Maker's Mark, but I don't think it's appropriate for the show.
Yeah, we don't have time for one of Jay's stories. All right, should we get into this?
Let's do it.
So we talked previously about the disconnect between consumer sentiment and the data that the health of the economy. But the University of Michigan finally just released their Consumer Sentiment Index, and it saw a 13% increase in consumer sentiment in January, but that made a total of 29% over the last 2 months. So, Jay, after seeing the results of this survey, do you think the consumers finally are catching on that this is a healthy and robust economy?
So, well, I want to talk about the consumer sentiment piece, but you know me, I can't just jump in there. I need to go on some long soliloquy about other stuff first.
Well, and you like my robust throw in there just because Mauricio's not there. It's his favorite word.
Well, hey, what is consumer sentiment? Does that mean just like people are good to go, or what's that?
I'm going to get there. Jeez. I mean, he comes on as a guest one time and he thinks
He's going to get there. It takes an hour, but he's going to get there.
he thinks he owns the show.
I've been on stage with Jay. I know it takes a while, so don't worry.
Okay, before I talk about consumer sentiment, let's recap a couple big economic data releases that we've seen over the past week, because I think this is going to play into the whole discussion on economic sentiment. So in the last week, one, we've seen GDP, which is kind of the total output of the economy for Q4 last year, come in higher than forecasted at like 3.3%, which is a huge number.
Until it gets revised.
But actually, this one doesn't get revised nearly as often. And historically, it's revised up as often as it's revised down. So I think we're probably pretty close at 3.3%. So basically, people are still spending money. Then about 4 or 5 days ago, Core PCE, which is basically, it's the Fed's favorite inflation gauge. It's the number, we talk about CPI a lot, but the Fed actually likes this thing called PCE, and Core PCE is basically the inflation indicator if you subtract out energy and food. That came in at 0.2% for December. So just to put that into context, that's what we want to see every month. If we see that number every month, basically the Fed's going to say we're right on track. We're exactly where we want to be. And if you look back for the last 12 months, so it's not just 1 month of a good number for inflation. If you look back over the last 12 months and you average basically the last 12 readings of this Core PCE number, what we see is 2.9%. So still above that kind of 2% target we're looking for, but not too bad. So basically inflation over the last year is looking pretty decent again. And then the other big one from a couple days ago was a bunch of housing data. So Case-Shiller data came out, which basically measures mean or median home values. We hit a new all-time high in November. Home values across the 20 biggest metro markets was up over 5%. So home values are going up. At the same time, new home sales soared 8% in December, and pending home sales, so the number of houses that are basically under contract getting ready to sell, that hit its highest rate since December 2020 as well. So people are starting to sell houses again. I'm guessing that's probably because mortgage rates started coming down in December after the Fed indicated that they were done hiking. So all in all, I mean, more economic good news. It just keeps coming. Now, this leads us into this whole thing about consumer sentiment. And anybody that was listening 2 weeks ago, we did a segment on the disconnect between the data, the economic data, like the stuff we were just talking about, and what people were thinking and feeling about their personal finances and the economy. And basically the story was the data looked great, but people were still pretty underwhelmed. People were feeling pretty bad. Consumer sentiment was pretty much in the toilet. But here's the thing. I had ignored December's number. December's number basically indicated that consumer sentiment was starting to turn, but I kind of wrote it off as a blip. But January's numbers just came out on Friday. And as you mentioned, Kyle, basically another 13% increase. So just to bring it up on the screen so everybody can see kind of where we are. University of Michigan puts out this survey, and then once a month they release this survey. And so here's that University of Michigan chart for anybody that's watching this. If for anybody that's listening, basically what we see is we were at like 68 on the index, and the average in the index is somewhere over the last 20 years. We're probably somewhere around 80, 85. In January, we jumped from 68 to about 78. So a huge jump in consumer sentiment, according to the University of Michigan. But it's not just the University of Michigan that said that. So the U.S. government puts out their own survey, or not, I'm sorry, not the U.S. government, an organization. It's a nonpartisan, it's not part of the government, but they align closely with the government, called the Conference Board. And it's the other survey of consumer sentiment that a lot of people look at. And they basically found the same thing. Basically in December and January, people started feeling really good again. And so since June of 2022, consumer sentiment's up 60%. The other interesting
when you say really good again, though, like if you pull up that chart again, like we're still nowhere near where they were back pre 2019. Like that was at like 100. And if you look at we hit its lowest almost ever back in June 22, I think it was, and that was down to 50. So if you look at 50's the low, 100's the high, we're still kind of right in the middle there. So we're, as far as, yes, it's going up, but we're still not at that point where people are feeling good, I don't think.
But it's a trend, and it's indicating that people are starting to feel better. Interestingly, according to the University of Michigan, I dug into the data a little bit. It was bipartisan. So Democrats and Republicans alike, not exactly the same, but within about 5 percentage points, are both sides are feeling good. And then the University of Michigan report, they also did a supplemental report, which I thought was pretty interesting. They kind of did a survey, they did a survey of people whose college loans restarted in October. So I know we've theorized on this show that in October, when college loans started were required to be paid again, that it was going to change people's spending habits. And so a couple things that came out of that survey, and I'm going to read directly.
Do any of you guys still have college debt? Just out of curiosity.
No.
Do we have college debt?
Oh shit, baby.
I think I still owe like $1,100 that get paid every month and stuff. I've never paid it off. I think I pay like $100 a month right now. I don't think I ever
hold off, and so Biden will take care of it for you. Just hold off, dude.
So I'm my fingers crossed. But I know I still have college debt. I think it's right around $1,100.
So let me read a couple things. So I thought this was interesting. Then I'll turn it over to you guys. I know I've been hogging the mic here, but basically between September and January, when college loans started to resume, respondents to the survey basically said that a very small minority of Americans, so basically responded to the survey, a very small minority of those who had to start repaying their college loans reduced their spending following the first payment. So basically, a lot of people are saying that they started paying their loans, but it didn't change how they were spending. That said, the survey also asked if they would be making adjustments to their financial decision making. And the most common response reported by about 40% of student loan borrowers was that they would be reducing spending in response to the restart of student loan payments. So it is interesting that back in September, October, a lot of people started repaying their loans, and they said, I haven't changed my spending habits since I started repaying the loans, but I'm expecting that I'm going to, which I find really interesting, because does that mean that people really intend to change, or they just want to change, but they can't bring themselves to do it? Because if this was really impacting people, you'd think they would have changed already.
Credit cards, baby. Beautiful thing. All-time high right now. And, once we see that pivot from the Fed, everything's going to be fine. So we're just holding on. They're just waiting for that.
So there was one more quote. Since you brought that up, I'm going to read this one more quote from the University of Michigan report. Our data shows that borrowers who are already more financially vulnerable due to their lower incomes, lower educational attainment, and weaker income prospects have resorted to spending on additional credit to maintain their spending, which suggests they've incurred more financial risk going forward. So it does look like the data supports exactly what you said. The people that are at most vulnerable, not necessarily everybody across the survey, but those who are most at risk, have resorted to spending on more credit. So
we're at almost an all-time low in savings rates historically. I mean, we're back to, 2008 kind of time frame.
I'd be interested to see too, like how much the performance of the stock market lines up with consumer sentiment as well. Just because like the stock market's been on a tear the last few weeks, and it wouldn't be surprising to me if everyone thinks everything's fine just because of the stock market.
Well, and with the inflation, I mean, obviously that's a huge driver, and energy prices. I think between energy prices, inflation, and the stock market up, those are the main drivers. And, we've gone to a lot of extent, obviously, on a few of those things, but, those are big drivers for middle America, as just the overall feeling and how they're doing is when they look into their 401k and see their 401k is up 30%, that really changes your outlook on your future.
But it doesn't. Sorry. I didn't mean to interrupt, but it doesn't just change your outlook. It actually changes your situation. Yes. So we see housing prices are up 5% over the last year, which means people have more equity they can pull from their houses. Stock market's up, so people have money they can pull from the stock market if they need it. Bitcoin is up, not to say that a lot of people invest in crypto, but enough that if you're investing in crypto and you need cash, you've got some place to get it. Gold and precious metals are up. So if you own a bunch of gold and you're running into a cash crisis, you can sell that. I mean, we're talking about spending on credit, but hard assets are up so much that if people need extra cash, they've got it available.
But a lot of people pulled out all their equity though on their houses and stuff over the last couple of years. And so I'd be interested to know how much of them still have any money left on that as well. Because a lot of,
or if you even want to take it at these interest rates either.
Correct.
If it's even accessible. And I think this is the worry, right? It's like we're in go back to energy. We're down to like the 80s level in American reserves, because in order to get gas prices down, the government sold off half of our reserves. So they literally got rid of half of our oil reserves that we had to try to get gas prices to go down. We've now stopped inflation, right? And the stock market's on a tear because they believe that interest rates are going to come down. Well, it worries me is all of a sudden people are like, oh, we can spend, right? And things are going okay. And then all the Fed does is say, hey, the economy's not, the whole reason the Fed said we are going to not continue raising rates, right? And there may be a chance we'll lower them, was because the economy was going down. Everybody was so negative, everything else. A sharp turn like this that is not predicated on fundamentals, that's really concerning to me. Because if the Fed then says, we are not in a place right now where we can actually lower interest rates, the whole thing holding it all up is now gone. And the Fed was reversing courses because they were seeing deterioration, right? That now has all changed literally in the last 3 months since the Fed shifted direction. Stock market up, rates went down, home prices up, right? And that really changes the outlook when inflation is the driver here of all of this in the Fed.
I think everyone was a little bit hopeful too that every time they were speaking, the Fed was saying, like, they were just saying things to manipulate the market instead of what they actually believed. And like, if you go back to the beginning of when they were doing the interest rate hikes, all they would say is how long it's going to take for what their interest rate hikes were going to do to the economy. They were like, oh, this could take 12 months. This could take 18 months for this to work its way through the economy. But then all of a sudden, when we're getting to the back end of this, they're not saying that anymore. They're not saying that, oh, that those 75 bip hikes that happened 6 months ago, those still haven't worked their way through. You're not saying that anymore. But I guess though the hopeful thing is that they are seeing the writing that, okay, that's going to start happening now. If we preclude that and start bringing the rates down so we don't all of a sudden see that double whammy, then they have their finger on the pulse and they got it figured out. But that's a big assumption.
Yeah, I don't know. I think that I think a couple months ago I was at a party and I was like, I bet you the rates go down in 2024. And can anybody guess why? Maybe the rates might go down in 2024. Just maybe, like a reason why economics might do a little bit better in 2024 leading up till November in some capacity. And I'm not saying that that's the reason why the economy is doing better, but I was guessing like about 4 or 5 months ago, I was like, economy is going to do pretty good in 2024. election year.
That was the number one reason they were saying March too, right? Is because the Fed doesn't want to seem like they're political. So which means they can't do any hikes like right before November, or they can't do any cuts right before November.
They've only ever done it twice in the history, and twice in the entire history. They've lowered rates. So that's actually way more common. So there's been plenty of instances where the Fed will lower rates going into a recession, but they will stop rate hikes.
Yeah, I mean, historically, the Fed is going to implement policy in support of the incumbent. And if you look back, and I've looked back 20 or 30 years, and basically what you find is it doesn't matter if it's Dem or Republican, but the Fed is going to support whoever's in office. Probably because that's the person that put him in office or kept him in office.
I was just going to say, because Powell was a Republican appointee, right? So he's actually Republican.
Yeah, and he pulled out a bunch of stops when Trump was running for re-election in 2020, and I suspect that he's going to do the same thing for Biden this year. And so, yeah, like we were just saying,
why though? When you say he would, why would he do that? He's not up until 2026. He probably, like, if Biden loses, it's probably going to be to the guy who put him on the board. So, like, why would he pull out any stops for Biden right now?
Well, I think the reason is why they do it for incumbents is twofold. It's way worse if you get a guy fired than someone gets hired despite what you were doing. That looks way worse. And two, historically speaking, if you're a president and you're not in a recession, you get reelected, right? It's actually really hard to knock an incumbent off unless you're in a recession. If you're in a recession, it's 100%, right? The moment we were in a recession, Trump was done. It was over. So when you look at that, first of all, just betting alone, you want to keep things sailing. But I still think it's different getting someone fired versus doing something that would maybe get somebody hired, maybe. I think you run way more risk with looking like you're attacking someone.
I'm not saying that he would purposely try and hurt Biden. I'm just saying, like, to Jay's point of, like, them going out of their way to help the incumbent. I don't see any reason for him to do that. I think he's more likely to do something. It looks like odds are starting to shift that March isn't going to happen, but maybe June we'll see a reduction in the rates in June, maybe one more the meeting after that, and then silence. I think he just does nothing, and he just lets the election kind of do its thing and then pick up the pieces afterwards.
That's historically speaking what they do. They just want to hands off. Like, they don't want to be in the conversation at all.
So just going back to something Tarl mentioned before, because I didn't know the answer to this, and it seems like a really important question that we should know the answer to. And so while you guys were talking, I did a little bit of research. And what I found is, this is a chart for anybody that's looking of basically. I
said, everybody look at your speakers.
Everybody look at your speakers. Exactly. For those watching on YouTube, you see this chart. For those that aren't watching, basically what we're looking at is a chart of owners' equity in their homes. And so what we see is that we were down around $9 trillion back in 2014 after the recession. That led up to about $28 trillion leading into COVID. Then we saw a spike in 2022 when prices spiked, a small drop down, and now we're back up to about $32 trillion. So I think based on this, it looks like we're kind of at an all-time high for owner equity in their homes. Looking into the data, you can't see it on this chart, but basically what I found is that the average homeowner that has a mortgage has $200,000 in equity, not including the 20% that they have to leave in. So if they were to refinance at an 80% loan to value, average homeowner still has $200,000 that they can tap. Now, we all know that interest rates where they are today and HELOC rates are a little bit higher than 30-year fixed mortgage rates. People aren't going to tap into that equity unless they really have to because it's expensive. But if the average homeowner that has a mortgage, and think about it this way, 66% of people live in owned homes, and something like 2/3 of those, so somewhere 40-some% of people lived in owned homes that have a mortgage. Of that, they have an average of $200,000 in equity. So there's a lot of money floating out there.
I think that's skewed though, because like half the U.S. their property is probably worth less than 200 to 250, and so that's probably skewed by the West Coast and some of the East Coast.
Fair enough. And yeah, I this is definitely, I mean, what we've talked about on the show a number of times is that we have this gap, this wealth gap. And
would be interesting to, I can't pull this data out, so I'm totally pulling something out of my butt right now. But this is a hearsay, she said, kind of whatever hearsay thing. A good buddy of mine that does a lot of foreclosure work and like, little sneaky foreclosure stuff that he does. He's like, bro, foreclosures are going up. But what's crazy is most of the foreclosures he's finding, which is blowing him away, are people that bought houses in 2020, 2021, 2022. It's all people that bought houses in the last 2 to 3 years, which I wasn't really expecting that for him to say that. But it also then made sense that to see foreclosures going up in that demographic, because they bought at, especially if you like, I look at like Seattle, my market, where during that time period, I mean, you'd have 20 people put in offers on the same property. And so you just get hyped up on the emotional high of buying a property at a peak. Like I know the house I live in right now is not worth what I bought it for in April 2022. So it's, that kind of makes a little bit of sense to some degree, but that's starting to go up in that little bracket of people.
yeah, but that whole foreclosure thing, I mean, we've all heard those numbers. Foreclosures are up 20% this month, 50% this month, 1,000%. But the numbers are so low that even
when you go from 8 to 10, then it's
exactly, that's a 25% jump, but basically it's two houses. So yeah, that's the thing. It's that the numbers are already historically low, so even large percentage gains don't mean anything. But again, I mean, we're looking at trends, and if that's the trend, it's worth keeping our eyes.
Well, we want to talk about trends, like too. If you look at that, if you looked at that graph and you looked at the trend line, we're actually looks like we're right back on trend line as far as where the equity is. And so we saw that spike up in 2022, and it looks like maybe we just reverted back to where the trend line is historically. So that's maybe an indication that we're not in that much trouble.
You know what's interesting? I've noticed when we're looking at not just housing, but the economy as a whole. I don't know if you guys have noticed this. I was talking about this the other day. I have not had this many good resumes on my desk in 5 years. I'm actually blown away at the quality of resumes that I'm getting. It's the best that I've seen. I mean, 2 years ago, it was a struggle to find qualified good people. I mean, it was, and what we had to pay them was astronomical. It was a like borderline like crisis in companies. That has changed so wildly today. I feel like we have the pick of the litter. And it's interesting because it's not people that are necessarily unemployed. And I'm not sure exactly, right, what's either driving that or what's going on. But there's not one position in my company that we probably could not find a replacement, not only immediately to at current salary, but get people that are just as qualified or more qualified. That hasn't happened in years.
Maybe you answered your own question there. Is it probably at that salary? It seemed like everyone in those last couple of years, they were chasing salaries and they were just going, hey, who's going to pay me the most and who's going to let me work from home and who's going to do that? And they were kind of just not looking at what's the best situation for them as far as job satisfaction. And now we're getting into a time where everyone's like, oh, okay, like this they want me back in the office, and maybe they're paying me a lot, but it's not as good of a job as I thought it would be. And they're willing to look elsewhere. Because to your point, yeah, everyone we hire for our job opportunities, no one's unemployed. They're all coming from somewhere else. They all got a different job. We had maybe one candidate who worked for themselves, but everybody else was coming from somewhere else.
Well, they all got done selling real estate loans over the last couple of years, so they're looking for new work now.
Exactly.
Yeah. Actually, I think
or you get a real estate agent, right? There's got to be a few of them kicking around right now with looking for work.
I literally just wrote a whole blog about like, where did all the mortgage brokers go? I mean, they're still out there. Are they holding signs? Like, where they just disappeared. So
I think that's a topic for an upcoming show. Let me just finish off this discussion. So for talking about economic data, the rest of this week should actually be pretty interesting. I'm looking at the economic calendar right now, and we've got a lot of business data coming out at the end of this week. So the last week or two has been a lot of consumer data, which is obviously important. but I find that business data is a better leading indicator than consumer data. And so over the next couple of days, we've got some manufacturing data coming out. We've got auto sale data. We've got hourly wage and unemployment data. So it should be interesting to watch over the next week to see if the forward-looking data, the business data, coincides with a lot of the consumer data, which is more rear window type data.
Keep an eye on that stock market. Maybe we're up for new highs again. All right, we ready to move on here? We got Tarl, so we might as well hit him up for some knowledge bombs. We talked previously about the value of events and conferences have both to new and seasoned real estate investors, but we never really dove into the specifics of these events because it seems like everyone these days has their new meetup or their new summit or mastermind or conference. But the question I have for Tarl, since he's in the event space quite a bit, is are these things really worth the time and effort that it takes to put them together?
That's a good question. None of us here on this amazing podcast would know each other without conferences, events, meetups, masterminds, and so forth. Like every one of us met each other somehow at a conference. Like we met Kyle because of his wife, Ashley, at the mastermind in Maui. We met AJ the same way. And then I met Jay at a best ever conference with those guys that do those things. I can't remember that thing. But anyways, and then all you guys have been to my events, right? And so we all hang out at events when we all see each other. So
if it weren't for conferences, we wouldn't know you. So is that I'm missing, is that a for or against?
Yes, that positive or negative? I don't know.
We stay away from conferences?
Yeah, stay away from conferences. Yeah, guys like me trying to headhunt you, right?
Well, and just quick, since we're shouting out conferences, it was called the Mid-Atlantic Summit, Jay? It was Dave Van Horn's event, and that's where I met Jay back in 17, 18, something like that.
Yep, and Tarl and I met at the Best Ever conference. And AJ and I met through an online. The very first time we met up was through a webinar that Tarl did for his online group.
Yep. And it's all from that networking, right? So I know for me, so we actually started doing meetups back in December 2016. And that just was like all our meetups locally in Seattle kind of sucked. And I was sitting there with my team and I was just like, let's do a meetup. Sounds fun. Let's do it. Right. And so 2 weeks later, we had 110 people show up to a meetup where I just like taught and did a bunch of networking and stood on chairs and had fun. And then people wanted to do it again. So the next month we had 220 people show up. And then the next month of that, we almost had 300 people show up. And then we just like kept doing it every month after that. And then eventually we created a conference called the Big Badass Real Estate Wealth Expo. And our first one was in 2017. And then that became a thing. And then it just kept growing. And now we run Limitless Expo. Now we run all the Better Life Tribe Expos. Now we run a bunch of masterminds. But it was never a business that was meant to become a business. It was just a event thing that I just did to do whatever I wanted with. And I've seen a lot of ups and downs with it. I've seen a lot of people come and go with events. We've lost money. We've made money. We've built an entire business around it now. And I've learned a lot from it, but I've also met a lot of people that want to start their own meetup and they want to start their own event and they want to run a conference or they want to do, I had a phone call the other day with a guy that's actually in Pennsylvania area. I think he knows you guys, Kyle, but where he's like, I want to start running events because I want to, I have a construction company and I have an acquisitions business and I want to like find more people to do deals with here locally, but I also want to find LPs because we raise money. And like, so he has all these reasons to want to do events, but that's one motivation to do it. But people all the time some people are thinking that like events are easy or they're going to get something out of it. Just like social media or whatever, right? They want to, people think that if they want to get successful in real estate, they have to have a social media account. And for whatever reason, if they want to raise capital, maybe they have to host events or sell something or whatever. But side point. So what I'm here to say is that when we started doing meetups and we started doing events, we did it all wrong, right? We actually were more known for doing all our real estate stuff. But we just started doing it because we wanted to meet cool people locally and do more deals. And so we kind of figured out if we started hosting up meetups locally, then maybe we'll get more wholesalers to show up to the events and then we can buy more deals. Because that was my acquisition strategy for a long time, was buying through realtors and wholesalers in Seattle area. So the more I hosted events locally, the more I'd become credible locally and the more deals we would potentially get from our events. I could ramble on this topic for a long time, but
it sounds like there's kind of two big things you're talking about, though. There's the hosting local events, getting people together, networking, building your credibility, building trust with you and your company, versus, hey, I'm going to spend a year putting together a big conference like your PNW Big Badass conference that you did every year, which can potentially be a big moneymaker
and lost
or loser. Yeah. And so, I mean, how should we be thinking about those two different playing fields?
No, that's a good question. And also there's masterminds. I mean, there's always somebody trying to sell you on some sort of event right now, especially the more you're in like social media and so forth. So I got to on that. So if you're thinking about starting your own thing, there's got to be a reason, like why. I could tell you, if you want to make money, if that's the reason to do like a meetup, that's the absolute wrong reason to do it, because you're not going to really make any money at it, right? There's not much money doing meetups. If you want to make money and you want to run a conference, right, and you're going to do it just off of ticket sales, sponsors, whatever, very unlikely you're going to make very much money at that. If anything, it's going to be a lot of work, a lot of stress, and you won't make very much. You'll probably lose money, right? To be honest with you with that. There's really only, at the end of the day, if I had to go back in time, if the reason why we were doing like meetups locally wasn't for getting deals, we would have been doing a tremendous amount of work for nothing. Basically, we were working for free. At that point, we were just giving tons of value to people locally, but getting nothing in return. Our in return was deals, right? Basically, we didn't have anything to sell. We weren't a hard money lender. We weren't any of that kind of stuff. If we were, that's another motivation. So if you are a real estate agent, or if you're a mortgage broker, or if you own a lending company, or you're a title or whatever, you have some sort of service, then that becomes another reason to host local events, because you're building a clientele, right? I wish I was a hard money lender back when I ran my meetups and stuff. We would have killed it. Instead, we had hard money lenders like giving us money to be able to be at our events instead. And so that's, a big miss on that part, I guess. But if you're going to start hosting one of these things, then you got to have a real reason, a real purpose, and never like sway away from like why you're actually doing it. And man, I can go so many rabbit holes on this stuff, but I can tell you how.
Well, I think an interesting point here, and you and I have talked about this, because I remember asking you a bunch of questions about your conference that you did a few years ago that I came to, and I was really intrigued on these things. And we talked about like just the economics, and it kind of blew my mind, because I always assume you want to put together a conference for 300 or 400 people. Yeah, you're going to spend $10,000 or $20,000, and yeah, you might make $10,000 or $20,000 or $50,000. And then talking to you, it's like, no, this isn't a $10,000 or $20,000 or $30,000 thing. This is hundreds of thousands of dollars. So there's not just the cost, but there's the risk, because correct me if I'm wrong, but a lot of those are upfront costs that, like, if the conference doesn't go, like, didn't you have something with
so AJ, I'm not going to share any explicit details, but you host a event that was like 120, 150 people a circle or something like that last year.
Yeah, I had two. We had the one that was 150, and then we had the storage one that's about 200.
Did you make money on either of those events directly?
No, I've never made money on an event that I put on. Never even planned to.
And I think everyone seems to be figuring that out all at the same time, because you see conferences that were $400 one year, and then all of a sudden the next year they're $1,100, because they probably figured out the first year, oh, geez, I lost a bunch of money in this. I got to try and make up for it. And it seems like all these conferences are now over $1,000.
Yeah, my first conference, I spent $150,000 after everything was paid for, after everything was done. I put 150 grand into it. And I had some people that were putting it on with me, and they're like, we can't do this again. We got this, inverse this, make this 150,000. I said, then you don't want to partner with me on events. Cause like, that's not the primary driver, like Tarl's saying. And I'm not saying that that's right. I'm not saying that that's right at all, but just more of along what Tarl was saying, I understood why we were doing it and what we were going after. And I've been to, obviously, most of Tarl's events. I've seen them, everything, and they're very consistent on why they're doing them and the purpose. And I think a lot of people want to imitate that kind of stuff. But two, Tarl's been doing this for not only ever, but he started out saying, we have a reason why we're not doing this to make money. And I agree. The people that come out and say, we're going to do this event and we're going to make all this money, it almost never works out.
No. because you can have the greatest event in the world. You got to get people to show up, right? And so they got to sell tickets, marketing. That's all expense. There's a trick too. Like if you see an event that's like, I don't know, hosted in Vegas and it only costs like, I don't know, 100 or $200 to go to it. And you see all these big, huge speakers at it, right?
They're selling you something.
They're selling you something. Like those are conversion events. There's really only two real ways to make money on conferences. One is tickets and sponsors, which is how we do it. The other way is conversion, which is selling you something from stage, which is what we don't do. We don't sell from stage. So it's actually, you have the opportunity to make a lot more money at a converting event than you do at a ticket and sponsor only event, just because you if you're really good at selling, right, then you can sell a lot of high ticket stuff. So kind of a trick.
The phrase conversion event is just that's sticking with me. That's
sound
right. It's true.
Yeah, that's what type of event, right? But yeah, they see people when you go to a converting event, they see buying units. They're like, hey, when you hear like people that sell from behind the stage or whatever, they're like, hey, how many buying units do we have out there, right? Which just means like qualified buyers. And so you might be able to get 300, 400, 500 people in a room, but that doesn't mean they're qualified buyers. So you'll have all these speakers come out that sell stuff, and they'll be like, what's the demographics of the room? How many of them are buying units? It's an entire industry of people out there that like all they want to do is go to the stage and sell, right? That's how they make the money. As a host of the event, right, you're the sponsor of the event, basically, you're able to, typically what they'll do is they'll split whatever they sell from your stage with you, 50-50 a lot of times, right? So not all events are that way, but most of them are. So if you have like these big A-level celebrities like showing up as a speaker headliner, and the ticket to show up is $100 and it's a 3-day conference, you 1000% are going to get sold something at that conference, because that's how they're going to make the money. Like you go to conferences like ours, right, or even bigger, business conferences type stuff. Our ticket price is going to be $800, $1,000, whatever, that kind of thing. And we're going to sell sponsorships at 50 grand, 60 grand, 40 grand, like whatever, because that's how we make our money at the event to pay. Like Limitless alone, without giving all the details away, Limitless Expo that Kim McElroy hosted cost us $1.4 million in cost in 2023 just to run and host the event. And so now world-class event, I might say, but at the same time, like I could promise you, egotistically, I'm saying this, that event, that was a $2.5 million event, and that we ran for 1.4 million, because we learned how to like cut costs and everything like that. We were getting bids for event management companies, because we did this whole R&D thing to see what other event management companies do. And we got 15 bids to run Limitless, just to see what everybody would charge us to host the event for us. The highest bid we got was nearly $3 million to host and run the event. And that was just to pay the event management company and not everything else that we really wanted. And so our lowest bid was a markup of like 30% of whatever the cost of the event was. So it was cost plus a bunch of other stuff. So it's not cheap to run these things at all, especially the bigger you get, because there's no economies of scale with events. Like if you're at 200 people and your cost per ticket, let's say is that to run that event, let's say is that like $100 a person, right? For your cost per person for event, you go up to 300 people, that doesn't make your cost per person go down to $80 or $70. It probably still makes it 100 or 120 now, right? Because you need more space, more food, more people, more chairs, more everything. There's no real economies of scale with events. The bigger the events don't get cheaper, they actually get way more expensive, which is a hard lesson for a lot of people.
I think it's really important too, because when you're going into these, because we all do, right? They're important, they're valuable, but when you're going into what Tarl just like brought up is, at the end of the day, what's being sold? How are you paying it for it? You need to understand that, because I can tell you right now, the quality between I paid up front for it versus, they're not the same. One, you are the product and you're being sold. But when we go into it, the driving reason. So Tarl's helping us put on events, and he asks, why? Why do you guys want to do this? What is the reason? And I'm like, brand, investors, meaning we want to build a good brand, have high quality information, so then people want to invest with us because we know our quality. So it's very content heavy. It's very like, we're not only back, we're not trying to sell. And he's like, hey, then you have to structure it this way. So there's certain things at a certain events you're going to get as an attendee because of the economics of it. And I think it's really important for all of us in the industry and in the space to understand, when I go to this event, what is the driving reason for the event? What am I paying to receive? Because a lot of people get frustrated and disappointed because it didn't achieve what they wanted. And it's because they didn't understand what they were walking into.
Yeah, they also hold themselves to a different, like, they're comparing themselves to other events that have different motivation and for different reasons. And so like you use an example like Brandon Turner, we run all his stuff, and he's just like, he loves Tony Robbins type.
He's that BP guy, right?
Yeah, he's that former BP guy. He loves Tony Robbins stages. Like he rates an event based on how cool the stage is. And I'm like, great, give me a $2 million budget and we'll make that stage happen. Right. Like, so you have to, a lot of people, what they do is they look at a event that might have all these awesome AV and everything's dope and everybody gets fed lunch and everything. They have to compare themselves to that. When that person like BP, Bigger Pockets, bringing them up, Scott Trench and those guys, Scott Trench told his people, he's like, we don't need to make money at this event. We just can't lose money. I want awesome networking. And that's what I want. Right. So I want it to be the best networking parties, right, that you can get. And we don't need to make money. Right. So if you look at that, you're like, I want to duplicate what they did. Great. You're going to lose money then if that's what you want to do. Right. Because they have a different motivation because they make their money doing Bigger Pockets. So full circle going back, right. It's so important. Like in my business as an investor, like networking's been like the number one reason for my success, like in so many ways, like get cheaper money, meet cool people, right? Get to structure different deals, learn new things, whether it's local or otherwise. And events
get on awesome podcasts,
right? But you can also have fun with these things too, right? Like Brandon and I created the Maui Mastermind, right? Or Maui Real Estate Mastermind, because somebody actually owns Maui Mastermind. I can't say that anymore. But Maui Real Estate Mastermind, that's like, that's how we met Kyle. That's how we met AJ. Get 20 people, 25 people that are vetted out to come to Maui and go on boats and have fun and do mastermind stuff and have, barbecues on top of volcanoes and everything is great. I'm recently, did we make money on it? Yeah, we made money at it, but like wasn't worth it. Like it was more to meet the people. And how many businesses and opportunities came out of that mastermind and other masterminds we've done because of, people being in those groups together. Right. Kyle, you came to the mastermind directly one time. You had an epiphany that changed kind of your business structure with you and your wife. You don't mind me sharing that for a second. Sorry. And now you guys are partners with Jay, right? And a bunch of other stuff's going on with that. But that didn't come from our mastermind, but epiphany did.
Basically did.
Yeah. So you get all these cool ideas, right, from going to these things, and you meet all these cool people, and then you can take that other places. And did we do it to make money? No, we didn't, right? It was because we wanted to meet other cool people. Actually, Brandon just was like, how do we get podcast guests to go do something cool in Maui and whatnot? That's pretty much how that started. I just created an event called Visionary Escapes. And it's basically like a high-end travel thing that basically we go like vetted out people that like AJ's, like you guys, like you three, and we go do once in a lifetime stuff like luxury whitewater rafting on like Class 5 rapids or whatever, right? In Cataract Canyon, Utah, which is actually probably where we're going to go. I'm going to make zero money on that event. I just want to go, right, and have cool people.
Quick interruption. So that's an event for people like the three of us. Did you guys get your invitation yet, AJ, Kyle?
Oh, we haven't promoted it yet, so don't worry. Yeah, it's for hardcore people. Like, I don't know.
It's funny. I actually know another guy I played hockey with, and that was kind of his retirement. Is he runs this thing called World Playground, and he sets up like what's he called, like bucket list adventures, and he just gets sometimes 6, sometimes I think I've seen as many as like 15 people to go on bucket list adventures with him, and that's his kind of like his new job.
So just to round this out, I do want to point out that there's risk involved in this, and and so what a lot of people don't realize is if you want to do an event, and I'm not even talking about like a limitless type 1,000, 2,000 BP, 3,000 type person event, like even a couple hundred people, you need to reserve that space. A year in advance? You need to find caterers.
Let me go down some of that stuff. I'll tell you some stuff. All right. So yeah, you need a venue, you need food. If you need it or not, I don't know. But you need venue, you need AV. Those are 2 things. You need a microphone, maybe, and you need a venue, a place to host it. All those things cost money, right? All those things are all over the place. If you go to a traditional hotel, you're going to go deal with food and beverage. You're going to have big minimums. A lot of time, like give you a case in point, like we won one year, 2018 Expo. We had our initial food and beverage bid was for $120,000, which means the hotel would give us the space if we did $120,000 of food and beverage in a 2-day period. We then negotiated that down to $15,000, right? So there's if I didn't do that, I would have lost a lot of money because we had to spend about $50,000-$60,000 on food and beverage for that year in 2018, right? Now it's totally dramatically changed since over the years for how much we're willing to spend. But if I would have kept it at 120, then that would have knocked out another 60 grand out of my profit margin because we only spent about 50, 60 grand instead. So being able to negotiate these things are huge, but you're obligated to that. If I would have signed the contract at 120 grand, I'm obligated to pay that. Right. No matter what. Right. And they'll hold you to it, especially they got really good at contracts since COVID. I was able to get out of a huge contract during COVID that since then Marriott, because I see their contracts have changed the clause that allowed me to get out of it. Right. In 2020 to not have to write this huge check when we couldn't run the conference that year. And they've changed it now. Now it doesn't matter if another COVID happens, you're still going to write the bill because they've changed the contract. But that said, like, yes, yeah, at the end of the day, like if you just want to start small with a meetup, right? A lot of people get scared of charging money for meetups. So I want to talk about that for 1 second and then we can move around. But a lot of people get scared of charging money for meetups. Like we used to spend about $1,200 just for like every meetup that we did just to like get one opened, right? That was like $1,200. And so I think it's rude for people to expect you just to eat $1,200 if you're just hosting a dope meetup, right? But there's ways around that. You can get a sponsor to pay for it. So maybe a hard money lender or two wants to pay for it or share in the cost, and you can do it for free. You can get other people to pay for it. But we started charging $20, right? So every meetup we would charge $20. We would then use that $20 not only to pay for the venues that we had, but we'd also use it to have food there. We'd also use it to have, get speakers to come out, right? We do all that. And we also used it to pay for marketing. Because at the end of the day, it doesn't matter how cool you have an event. If nobody comes to it, then it doesn't matter, right? So there's a few like tips and tricks at the end of this rant, like that I could say is that if you host anything, collect emails more than anything. If you can get emails, get emails, get emails, get emails. Track people that are coming, get a CRM for it. If you use meetup.com, you don't get their emails, but it's a great, great, great thing to use. As soon as they come live, get their emails and start promoting that way. As soon as you can start charging for it, right? You'll get more people to show up. Free events people don't show up to, right? You can get it just like webinars. You get 1,000 people to register for a webinar and have 150 people show up. You can get 500 people saying they're going to come to a free event and get 200 people to show up, which will kill you if you are looking at your finances for projections and stuff. So basically charge, in my opinion, charge for everything, unless you have a reason to make money, right? Such as you're a hard money lender or something like that. And then if you're doing this on a regular basis, know it's a long haul for it. If people go to your very first event, they know all you did was just to sell them. They're not going to come to the next one. And so there's two last factors. If you have a meetup that you're constantly having 100 people show up to, and I ask you how many of them are new, and 80 of them are new every single month, that means you're really, really good at marketing and your meetup sucks, right? Nobody wants to come back to it. The other way around, if you have 100 and you get 10 every month to show up, you get 100 to show up every month and only 10 are new, that means your meetup's great, but you suck at marketing, right? And so keep running those data points to know like how many are new, how many are old, how many consistently come, allows you to grow and build that if you want to. And then track data, as much data as possible on your attendees. Like that was a huge myth for us for a couple of years.
All right. Well, let's move on to talk about a little bit of actual real estate here, and specifically commercial real estate, because the expenses right now are under the microscope and rent growth has subsided and interest rates are crushing cash flow. So everyone's looking to cut costs. And one way that people are reducing costs right now is using automation and automated systems. Now, AJ, it seems like when people talk about self-storage, one of the major claims that they are making is that tapping into these new automated systems is a huge value add, and that's how you can make so much money in self-storage. But is that really shifting the self-storage market that much, or is it just people kind of blowing smoke?
So this, I got to preface this because it's not that it's not true. It is. It's 100% true. I mean, I've invested literal millions into technology, but I think it's overblown, and I'll walk through you why in investing. So you have certain, let's take 3 different sizes: small, medium, and large. Okay. Obviously we know that there's a difference between 8 doors, 2 fourplexes and a 200 door apartment building as far as margin, expenses, how much that hits the bottom line. Well, in storage, we judge things on square footage. So under 50,000 rentable square feet, 50,000 to 100,000 and 100,000 plus. Doors don't make sense in our industry to measure it like that. So really what we look at is the expense load per square footage, right? So as you go down, let's say that you have a 20,000 square foot facility and a 25,000 square foot and a 50,000 square foot. The only real difference between the two is the amount of doors that you have. Operationally speaking, they're the exact same, right? It's like it doesn't, the variable cost doesn't increase on the ops side with the amount of doors you have. Now, the problem with that is then the expense load on that 51 down to that 25 means you make less money because the only thing it can do is hit your margin. And there's a few expenses that this focuses on, which is largely the management, on the ground management. So there's been this huge wave of people selling all these new things that you can do. And the idea was that you're going to come in and buy a storage facility and you're not going to use a manager. And we have this new thing that we're doing called automation. Now, it's true, but we've been doing it forever. This isn't anything new. We're just using different tools to do it. So this is something we've been doing for 20 years. We were doing in the early 2000s because you couldn't operate a facility on that expense load. So what happened is the way lots of times we operated is different. But there's no such thing as a manless storage facility. And that's what people tout. That doesn't exist. In operations and expense loads, you have two things. You have back end and front end. Nobody cannot go to a real estate asset. I don't care what kind of asset you own. Somebody has to actually look over that asset and make sure that things are working. In storage, we have to clean out units. We have to get them ready for sale. We have to evict people. We have to sell their stuff. And then we have to resell those units. That all requires you to be actually there, right? So instead, what we've done is we've outlined back end things, and we've automated the customer acquisition portion. That's really what we're talking about here. So what we do is the customer acquisition online, we email the communication, then they can go to the facility and rent it, right? Now, even that though, we have people, we have call centers and all sorts of stuff. All we did is move the people into the back room instead of the front. Now it's so when looking at it, it really is all pretty much the same. I think it's overblown in this thought that you can make all of this money. And there was a lot of people, I think, that were buying facilities that were maybe 45,000 square feet. And they found a great opportunity because there was a manager there full time and they got rid of the manager and they made $23,000, right? Or whatnot on that one thing. But two, a lot of times what they don't tell you is whoever they have, including them, that is going to do all the work. Well, just because you're doing the work and you're not paying for it doesn't mean the work's not getting done. You're just not paying for it because it's you doing it, right? So when we look at it, the amount of savings, it is there. It is big. It's not that it's not true. But I get very nervous about it because a business model that's focused on cutting expenses instead of growing revenue, those are always scary business models to me. There's only so far you can cut at the end of the day, right? And the expense load that you're saving, although it's true, I see people that do this. And this is where the whole thing came to a head and people got in a lot of trouble. What they were doing is they're creating funds and they were spending hundreds of millions of dollars. And they were saying there's a 35% expense ratio. I can operate it at a 15% expense ratio. We're going to sell it. And the difference between that goes to the net income. We're doubling our net income and we just created massive value, right? That actually works. They can buy it at 35. They can go down to that 18 or 19. The net income rises. So now theoretically the value would be there. But in order to get that value, what do you need? A buyer. So no fund until the last year we had one, but none of them could sell because when people sell, they underwrote it at a 35% expense ratio. They said, I don't care that you have a 19% expense ratio because whatever you're doing. And a lot of people got into a lot of trouble because now all of a sudden this value could only be extracted if there was someone to pay for it, and nobody pays for it because the operating model couldn't transist, meaning that's great. You can do it, but I'm not set up to do it and I can't hire somebody to do it. so I can't pay you for it.
Well, and buyers always just assume that sellers are lying, right? Like every time I get an expense report from an apartment, like I just look through and I say, okay, I know this is unrealistic. This is unrealistic. They're doing something here. And you just assume that they're lying to you from the beginning, and you're going to run in your own numbers the way that you operate a property anyway.
Exactly. Like I tell people, your expense load doesn't matter. Mine does, because I'm buying. So just because you have a 19% expense load doesn't mean I pay you for that. I'm buying off my expense load. And so all of a sudden we had all of these assets on the market, and we had these big funds that came out, and none of them could sell. And that equity sat there, and all of a sudden it was, well, how we get it. Now, the big leaps moving forward is that Extra Space bought a company that did small assets in March, and there's an idea that they're going to get into the space, and it's becoming more and more prevalent. So will there be a time that lower expense ratio is actually transferred on small assets? We believe so 100%. But right now, that doesn't translate well into the big assets. And people are like, well, I could automate a large asset the same that I could as a small asset. And the problem with that is this. All right. So I have a 150,000 square foot facility. Its gross revenue is like $3 million. A $50,000 manager, I have 1,500 doors at one spot. There is never going to be a world which I don't have a manager there. Why? Because I have 1,500 doors with people in the lots, obviously, coming out every day. I have entrances and exits, 3 gates. I have 12 entrances and exits. There is no world that we will not have someone sitting there, because what we pay them is irrelevant in not only our gross revenue, but the problems that would incur. I mean, if I had to send somebody there every time we had a problem, I would incur more cost than hiring a full-time person there.
But even if you could get completely rid of that person, $50,000 expense on a $3 million asset is less than 2% of expense ratio. So, I mean, even if it was feasible that you get rid of that person and it doesn't cost you anything extra, your savings isn't that great.
And you're probably only saving 30% on the upside too of whatever system you had to put in to replace that person.
So let me ask you a question. Let's make this actionable for anybody, because I know we have a lot of listeners of this podcast who like self-storage, and we also have a lot of LPs that listen to this podcast. So just to make this actionable, because I don't know the answer, and I'm curious this myself. You mentioned previously 35% expense ratio. If I'm underwriting a self-storage deal or a fund, let's say I'm going to invest in a syndication or a fund, what's the number that I should be looking for a stabilized expense ratio? And let's not include
30 to 35% is typical.
Okay.
The smaller you go, generally speaking, the higher it is. If I'm buying a small facility, which we do, and I would today, I'm not paying 19%. I don't care what the owner says. So those are the buyers and where we're at. That is a normal actionable expense ratio. There's a lot of these expenses outside the manager that just really don't matter. Property tax, right? All of the big stuff. The little things that you talk about when you say customer acquisition or sell, like that is so little that you're not going to drop an expense load majorly. Basically, the only expense in there that really drops is labor. And so what we found is, guess what? If you're a third-party management company that does small facilities, the average payment is somewhere between 11 to 15% of gross. On big facilities where we have a manager on site, we are 6%. So they have to charge double to operate it. Why? Because they have people in the back that actually do the thing. That's why I say it is true and it is possible, and automation is helping, but it is not some big thing that is, like you think you can just walk in and you're going to make a quick turnaround and huge. It's not that you can't. We do it, and I'm a proponent of it, but you need to understand what we're talking about and why.
So as an LP, if I'm thinking about investing in a deal, where's my bullshit meter kind of going off? If the VP,
if you're an LP and you're investing with somebody and their business model says, we're going to buy this, it's a 35, we're going to drop it to 19, and then we can sell it at this higher valuation, you got to ask, is the buyer going to accept the 19% expense load? Because if they're not, that equity doesn't exist. It doesn't. And the answer is, They're not. Or to expect that would be unreasonable.
Are we good? Are we good with 25? Are we good with 30? Where's the number that we should be saying?
Yes, 100%. 30 to 40.
Jay, you looking to invest in storage here? You're really pushing on this one.
I'm always looking to invest, and a lot of our listeners are too. And so I like to know when I'm getting
small
BS'd.
Facilities are higher. So a small facility, your expense load will be higher. So if you're under 50,000 square feet, the lower you get, expense load generally is higher. You can operate them at low expense loads, everybody. I'm not saying that. But if you're talking about an exit and somebody is underwriting a 19% expense ratio on an exit, that's where my BS meters would start going off, and I'd have a lot of questions. Because we just don't really.
Well, the
see
market's not there yet, right? Like at some point, that's
at some point maybe.
Self-storage seems like one of the first movers as far as automation is concerned. Like we talk about this, I don't want to get into it too much because we'll be here all night, but you talk about like AI implementation, stuff like that. Automation's much tougher when you're dealing with like multifamily because there's a lot more people interaction. There's a lot more, people are having to call a lot more. People are having to tour each individual unit a lot more. There's a lot more back and forth with people. So it's a little bit tougher. We've had to resort to more like VAs is kind of an easier way.
Yeah. Ours is back end business ops. So that's how we get those things. Now, two, before somebody reaches in the comments, says you're just like anti-automation or something, we were one of the first two in the world that did keyless technology. We literally manually inputted the first facilities to do that so we could have true keyless technology, meaning everything could be done from the phone. There's 2 facilities that opened up. We pioneered that with Janus Technology and Noki. I own a tech company that specializes in this, in property management system that is on the cutting edge, that does bank facial readings and everything. So we don't have to work with people as they get in. So I'm not only a proponent, I've literally invested millions of my own personal capital into it.
Yeah, I can vouch for the fact that
I was really worried that you're one of those people trying to take jobs away from AIs and robots and stuff. So it's good to know you're not one of them.
we need to start using those Boston Dynamics robots. Have you guys seen those videos?
Or creepy.
Is that the one that Amazon uses too? Where they showed the robot picking up the package, and after like 1,100 packages, he was just like, "I've had enough," and like sat down, was done for the day.
Put in his notice.
Yeah, anybody out there, go do a search on YouTube for Boston Dynamics robots.
Yeah, the dog ones are the creepiest ones. Yeah, it's an interesting topic. I think we do have to talk about this at some point, about the AI implementation into this. My problem with the whole AI thing is that it's just moving so quickly that I feel like something that I heard about 2 months ago that was $5,000 just to get implemented, now it's $500. And it's like, it's progressing so quickly that I know eventually we're going to have to implement it, and we have to keep a finger on the pulse, but we're just not quite there. We're not quite past the chat bots right now. That's the chat bots can answer questions for us.
They can do pictures too. Look at this. Look. Can you guys see that? Hold on. That's I said, hey, AI, here's the 4 core values of my company. Give me a graphic of people depicting the 4 core values of my company, and that was the graphic that it showed.
Looks like a sci-fi movie.
I know, right? Like
that'll encourage everybody to go to YouTube to watch it because you can't see that unless you're on YouTube. But that's really funny. So AJ, let me ask you a question, AJ. And
no more expense ratio questions, Jay. He's had enough of those.
Questions. But you brought up a really good point. And it's about the adoption of AI. And it just made me realize that there's 2 sides to technology. One, there's implementing it, getting it to work, and using it to make your business more efficient. But 2, your customers have to be receptive to it. And if I'm a 75-year-old woman in Omaha, Nebraska, going to a 5,000 square foot self-storage facility, am I really going to be comfortable with all that technology? Am I going to be comfortable signing up for a storage space without actually talking to somebody?
Siri, open up my storage unit for me, please.
Exactly. So what are you seeing on the ground, AJ, in terms of adoption from your customers? Are there any places where you wouldn't implement this because you just feel like your customers probably just aren't the right demographic or aren't technically savvy enough?
It's actually not the demo. It's not the adoption of the customer nearly that I'm worried about, is the cost of adoption. Meaning that if I'm doing keyless technology, I now have to hardwire and I have to implement the hard tech to the tech on the front end to the back end. So the hard to the software, right? And so when we implement that, there's an extra cost. So let's call it 150, 200 bucks a door, right? Well, over a lot of doors, that's a big number. And I think there's a lot of markets where that you cannot raise rates, and rates will not reflect the cost. So the tenants may love it, but you can't get anything out of it. And now you're just not price competitive. That's actually the biggest barrier of entry. So in markets where we can get it, we actually can see an adoption rate, maybe even a little higher. Now we have like add-ons where we give like key fobs to people. But what we found is that little grandmas actually don't like working with padlocks. So they actually prefer like a key fob thing. But we still have a lot of assistance for people on the ground.
Well, I'm sure storage too. It's probably quite a bit more price sensitive, right? Like if you have somebody who, like, whenever someone goes into a storage unit, there would be that the demographic that, that's a contractor or something. They're going in and out of there every day or every couple days. But then there's also the demographic that, puts their shit there and it stays there and they don't come back for 6 months, a year. And are they going to really pay $10 more a month because they can get an extra key fob or an entry than a normal padlock if they're not planning on going that often versus, multifamily? Like,
there's a lot of markets that won't.
Multifamily, we could charge that all day, right? Like we can, if someone will pay $10 more for their unit in order to have keyless entry because they're going in and out of their unit multiple times every day, and they love the prestige. And
$10 is 0.5% of their rent versus in the storage space, $10 could be 5% of their monthly rent.
Yeah, 10%. And so you're exactly right. The biggest problem with automation and adaptation, I see people overdo for what the market can even handle. And then they have this new shiny prized thing and the market's like, we don't care. Like, that's great, but I'm still going to charge $100 just like Bob is with the padlock down the road. And the only difference is you now have incurred all this larger expense. So the market needs to be able to adapt it and pay for it.
Yeah, you're incurring that large expense, and the person you're trying to sell to is not going to pay you for it because they're going to assume they're going to run it the way that they run it anyway. But interesting perspective. But we should wrap this up. We've already kept Tarl long enough, and since Mauricio's not here, I'm for sure doing a top 10. So that's just a given. But in light of, kind of as a thank you for Tarl coming, I thought I would do the top 10 speakers from the 2023 Limitless Expo, because he mentioned it before, and Limitless was like knocked it out of the park with speakers, one of the best speaker lineups I've ever seen. And so I thought I'd go through the top 10 speakers from the 2023 Limitless. And I thought about Tarl didn't count, but I did include Tarl in the list because he was a speaker as well.
And let's be clear, I was asked to be a speaker. I had a conflict, so I couldn't make it. But had I been there, where would I have been on this list?
You weren't there, Jay. I just assumed he didn't want you there.
Tarl can't afford you, Jay. He can't afford you.
And just so everyone knows, this is not biased at all, completely unbiased poll, nothing to do with my personal feelings or connections to the podcasts or anything. It's completely unbiased. Number 10, Brandon Turner. He deserves to be on the list, but I think he would have thought he was going to be number 1. So I just put him on number 10 just for that sake. So he's on the list, but he's barely on the list. Number 9, I have Thatch, just because my wife would kill me if Thatch wasn't on there. She loves Thatch, and he's got a great story too. So he's one of those guys I'll always go watch. Number 8, the Fetkes. Obviously Kathy, she was on the podcast. I didn't think they deserved to take 2 spots on a top 10. That's a big ask. So I lumped them together and put them on there.
I'm going hella skiing with Rich on next month, and I'm going skiing with Kathy this Saturday. So
they're great. Anybody who's got an opportunity to do anything with either of the Fetkes, they're a great time. Number 7, Ken McElroy, obviously fellow multifamily guy. He's got to be on the list. Number 6, Robert Kiyosaki puts asses in seats. You gotta go see him. Even he's going to be entertaining no matter what he says. Number 5, Chris Voss. I have him pretty high up there just because I love his book, and he's got that low monotone voice that I love listening to.
Radio voice.
And his wife is super hot.
Yeah. Actually, I don't even know what his wife looks like. That's going to be the number 1 Google after people listen to this podcast, I guess.
Googling right now.
Number 4, Tarl cracks the top 5. Number 3, Mauricio Raoul. Even though he didn't come to our podcast, I got to say he's awesome. Number 2, AJ Osborne making the list. Number 2,
yeah, I made it.
And number 1, obviously, was by far the best presenter. Anyone who went there, they just raved about this presentation, was obviously Ashley Wilson. By far, knocked it out of the park. So there's my completely unbiased list of best speakers at the Limitless 2023. I don't think you've released 2024 speakers, have you?
No, not at all. Yeah, not yet.
So keep an eye out on that.
I will be there just to announce that prematurely because Tarl doesn't know this, but I will be speaking this year.
He will be there one way or another, is what you're saying.
He's going to break in. He's just walk up on stage, take the mic, pull a Kiyosaki.
Pull a Kiyosaki.
All right, we got time for a quick game. I squeeze it in real quick. And the reason I'm throwing this out there is because Ashley, as I said, is at NMHC, and we share an Uber account. And constantly, all day, all I'm getting is Uber alerts. Your ride is on the way. Your ride is on the way. Your ride. Apparently, she's just going all over the city with Uber. And so it got me thinking, she's riding these Ubers by herself. And she's a bit of a talker, but some people don't like to talk.
Is that what she told you? She's riding by herself?
Yeah. Well, actually, she's got one of the people actually in our company. Yang's there.
Hey, I've been to a conference. I was at a conference with your wife in Chicago few months ago, and she was in Uber a lot, but it was on my Uber account, so you didn't get any notifications on that one.
Well, she's the type that'll sit in the front. Look at this. She's calling me right now. She's the type that'll sit in the front seat and talk to the driver, which got me thinking, what's your guys' preference? If you're going to get an Uber by yourself, are you a silence person? Are you going to talk to the driver, or are you going to be asked to listen to music or something of that sort? So we'll start with you, Jay. What's your preference?
If there's anything more than a, hey, how you doing? I start to get really annoyed. Like, I don't like talking to you guys, and you're my friends.
It's true.
I'm just an introvert. I don't want to talk to strangers, and that's a good time for me to get work done. So yeah, I'm not a talker in an Uber. What about you, AJ?
So I gotta admit, I'm kind of both, meaning that like there's sometimes I get in, I'm like, oh, hey, how's it going? I want to chat. I want to, hear about them. And like, I think that's all exciting. But after a long trip, there is nothing more annoying than getting in an Uber and then feeling like I have to entertain the Uber driver, right? I'm like, dude, I got my headphones in. Like, I want to sleep. Like, sorry.
Tarl, break the trend here.
I know Tarl's.
No, well, this one's easy for me. Like, it's 2 answers, right? If I'm going to the airport, I don't want to talk to you, right? If I'm leaving the airport and I'm in a city that like I'm visiting, I want to talk to the Uber driver because I want to find out where to go, what's happening. I've learned so much stuff that way. And then, but if I'm leaving the airport going back to my house, I don't want to talk to you. Like, so it's the, like, especially that one, like, don't talk to me, right? But if I'm going to the airport from where I was, no matter where that was, I don't want to talk to you. If I'm leaving the airport at my destination and it's a place I want to visit, I'm typically gonna like talk, and that's that.
So I have 2 answers, and it's kind of based on the time of day. Anytime during the day, completely sober. If I get an Uber by myself, it is literally my nightmare having a conversation with someone I don't know. I don't want to talk to you. I want to say, how you doing? And then I'm going to look out the window, and I don't want to talk to anybody. 2 a.m. rolls around, 3 a.m. I'm getting a ride home and I had a good night, had a few drinks in me. I'll chat up that Uber driver all day and I'll have a great time. So two different types of Uber ride. All right, let's wrap this up. Tarl, thanks for coming, man. We really appreciate it. I think it was a great episode. Went a little long, but time flies when you're having fun.
Yeah, I mean, like I could tell you guys just talk way too much. You have way too much fun on this podcast. It's a little crazy. And thanks for having me.
It's all my Diet Coke. It goes straight to my head.
You got anything going on recently here you want to plug, Tarl, since we have you?
Yeah, I got a newsletter, tarlyarber.com. You can follow that. I do cool stuff on it by writing. I write on it, and it's called a newsletter. So you can check that out. Of course, also the Limitless Expo. Go to limitlessexpo.com, and you can do more stuff there. So.
And Jay 100% will be there. So if you just want to follow Jay around, he's going to be there. AJ, you got a plug for us?
You know what? I'm gonna plug my other podcast. It's not nearly as fun and it's not as interesting, but it's me blabbing on about some relevant and different things. But it was really awesome. I had Jay on there, and we went for like an hour and a half, and it was one of the best received episodes. I got tons of feedback and tons of people listened to it. It was awesome. So go check it out.
There you go. Jay, you got something for us?
Well, if Tarl is plugging tarlyarber.com, I'm going to plug jscott.com because I've got a new newsletter also. I also know how to write, probably not as well as Tarl, but I use words good. So
Chat GPT.
I was going to say, Jay's been dabbling in the Chat GPT a little bit too. So
I'll challenge everybody to figure out what I've written myself versus what Chat GPT has written for me.
Or do you only use that to write your love letters to your wife, Jay? Is it just?
I do. Every holiday, I write a love letter to my wife using Chat GPT, and she's really getting annoyed with it now.
She's figured it out.
The opposite effect. Once again, I'm going to plug my wife. She's not here, but I'm still going to try and plug her. She's off at NMHC right now. And actually, I think, so this comes out Wednesday morning. I think she's actually speaking at Bigger Pockets virtual summit or something. So if you happen to listen to our podcast in the morning, go check her out on that. But if not, I'm sure she'll give you a good summary, follow along of what's going on in NMHC. If you check her out on Instagram, Badass Investor, YouTube, Badass Investor. All right, guys, I don't know about you, but my drink has been gone for a while. It's a long one, but I got to go hit the head. Once again, thanks, Tarl, for joining us. For the other guys, I will see you next Tuesday.
Later.
Thank you.
You got it.